Welcome, everyone, to this webinar, What a Good Investor Pitch Looks Like. My name is Will Smith. I'm the host of the podcast, Acquiring Minds. And today's session is with Chelsea Wood, co-founder and managing director of Acquisition Lab, and Andrew Hippert, principal at Shareholder Ventures. Welcome, Andrew. Shareholder Ventures and Acquisition Lab recently merged. You all know the lab as the cohort-based education community for people serious about buying a business. Many successful grads of the lab have appeared on Acquiring Minds. And Shareholder Ventures is a fund that invests in search deals. So it is indeed an exciting development for the whole space, self-funded space, or investor-funded space, as the new vernacular goes. That Shareholder and the lab are under one roof. I'm sure we'll hear a little bit more about that today. Quick housekeeping before I hand it over to Chelsea. As always, we are recording. You'll get a link to the recording and the slides in the next day or two. And if you have a question, go ahead and use the Q&A button of Zoom. So we have chat turned off. That's where you ask your questions. Today, we will do questions at the end, so we're going to go through the whole presentation first. But if you have, ask your question as you have it, and it'll be there in the queue. Depending on involvement by you all, listeners, audience members, there could be a lot of questions, so you can always re-ask later if you think it's gotten buried, your question. We usually don't have time to get to all the questions anyway, also, fair warning. In December, Tim Erickson, also with Shareholder Ventures, is doing a follow-up, a part 2 webinar to one he did a couple weeks ago on modeling a investor-funded SBA-style acquisition. Part 1 was all about kind of definitions and concepts and theory. And part 2 on December 11th is going to be walk through an actual model. So we're going to have a spreadsheet on the screen and really go through the nitty-gritty of a model. It's going to be very valuable and a great complement to the first part. So you can register for that here. So we already have the registration page live. So go ahead and register for that. And then second link, and then I will hand it over to Chelsea, is for a new investor bundle from the lab and Shareholder Ventures. I don't know much about it, so Chelsea's going to explain. And with that, Chelsea, please do.
Okay, I'll explain. So let me get my slides up. Hopefully you can see them. All good?
Got them, yes.
Okay. I know that I might be talking a little quiet, so I apologize. I will do my best to project to my laptop screen. So if you've ever attended my office hours, then you know that I try to make them very practical and based on what I'm hearing kind of in the market. And so when we were talking about potential ideas after Tim's last webinar, we were talking about the fact that, so we did at the Buy Then Build Summit, we did pitches where people could book with investors and pitch their deal. And one of the things that was really lacking that I would have loved to have done was educate people prior to attending around how to actually pitch a deal in a way that investors will respond well to. And so it made sense for us to do that in office hours format. So that's what we're going to do today. First, we're going to talk a little bit about what the deal pitching process looks like. Then we're going to talk about what investors look for in deals, and then how to actually position yourself to investors so that you get taken seriously. And then the last thing is really just a list of best practices for you to consider when you're putting pitch decks together. This is me. You know me by now. Andrew is the person that leads the Entrepreneur in Residence program that now lives within the lab, which was one of the biggest drivers for the merger. And it's just a really cool way for you to overcome the chicken and egg issue when you're using investors, right? And we can talk a little bit about that in the questions if you want, but he has a really great experience as well because he comes from a world of leading accelerators. And so he led the Techstars Sports Accelerator. So he's going to be a really great partner for me at the lab. So the first thing that I want to talk about is just kind of level setting so that everybody understands, like, this is a pretty nebulous space. And so we're going to try to put some frameworks around it, but it's important to recognize that investors are all very different, right? It's kind of like lenders are very different. And so it's important for you to recognize whether or not you need to take a deal first approach to pitching or a strategy first approach to pitching. And so most investors, to be clear, kind of lead with a deal first pitching. So they want to know what deal you have. They don't necessarily even want to talk to you until you have a deal in hand. And they want to understand the terms of the deal and if the deal makes sense. And then they get to know you a little bit more to figure out if you're the right buyer for the deal. The strategy first pitching, which is more the approach that Shareholder Ventures takes with our EIR program now for lab members, is
Chelsea,
yeah.
I'm really sorry to interrupt, but I don't want anybody to miss any of your content. People are saying that they really can't hear you. I got a bunch of people. It's not just that it's quiet, but that it's they're unable to hear you.
Can you hear me better now?
I can hear you the same. I can hear you. Other people are saying it's fine. Can hear perfectly fine at max volume. Okay, people are saying it's fine. Try again, Chelsea. Do another testing if you would.
I'm here. There's nothing else I can select. It's settings on Zoom, but I did have this issue on another webinar, and half of people said it was fine, and half said it wasn't. So I don't know what to do about that.
Okay. Everybody's saying it's low. Your volume's low, but I think that people can hear her. Can hear you. So I think we're good. It sounds like we don't have an option, everybody. So turn up your volume all the way when Chelsea's talking.
No,
Yeah,
do you want me?
I think
do you want me to call through my phone?
I think in the interest of time, it's okay. And it looks like people have turned their volume up. So let's do that.
Yeah.
Let's not do that. Let's carry on.
Let's start with that, guys. Okay, so with Shareholder Ventures, they're going to lead more with strategy, right? The EIR program that we host through the lab now focuses on you as a searcher. And so you go into it really pitching who you are and what you're trying to achieve, and they're giving pre-deal guaranteed dollars to their EIRs. And so it's important that you understand when you're talking to the investor group, which type of approach they're going to want. It's the same thing as not all of them are going to want a pitch deck, right? And so you need to kind of ask about their process and respect their process. But you need to have it in your mind whether or not you need to have a deal first or if they're open to having a conversation with searchers first, if that makes sense. Okay, so I'm going to hand it over to Andrew, thankfully, because you can't hear me. And he's going to talk a little bit about the deal pitching process.
Awesome. Andrew, talk a little bit quieter. Literally, people are saying that if turn it up for Chelsea, we got to be a little quieter. So just be aware.
You want me to be softer?
I think that's what people are asking. Yes, that's what people are asking for. Gotcha. So just you don't have to whisper, but just be aware, not to be too loud, I guess. Yeah.
Okay, great. I will do my best. Well, first of all, it's great to be here. Thanks, Will and Chelsea. It's always a pleasure to have the opportunity to present with you. I've heard so many pitches over the course of the last 7 or 8 years, really running Techstars, as Chelsea mentioned. We're focusing on sort of early stage, high growth founders, sort of trying to build a whole 0 to 1 model. And since launching Shareholder Ventures in January, of course, we've talked to thousands of searchers and looked at hundreds and hundreds of deals. So hopefully, this is going to be a good framework for any searcher that's interested in bringing on external or outside or investor capital, as we say, sort of the investor-backed search. As Chelsea mentioned, very true. Every investor is a little bit different. So I think really important to get an understanding of how they operate and what their process looks like. But hopefully this presentation will at least give you some baseline knowledge on what to expect and how to sort of understand the deal pitching process. We'll have a few slides that walk through what a standard pitch deck will look like and sort of how to conduct a good engaging pitch session with investors. So maybe just starting real quick on the initial reach out phase. I do think that, and Chelsea made a good point. Some investors, they don't want to talk to you until you have signed LOI, to deal in place, and they can come in and write a check and be done with it. Our approach at Shareholder Ventures, even prior to launching the EIR program, was always the opposite. We like to get involved early. We like to come in pre-LOI. It gives us the ability to help you structure the deal that hopefully will be more advantageous and competitive to you, and help you see around some corners and avoid red flags. And we'll talk a lot about what those red flags look like in today's presentation. But I do think that the initial reach out phase is very undervalued. My suggestion is if you're looking to build relationships with investors, whether it's reaching out on LinkedIn, it's going to networking or meetup events. Obviously we had our Buy Then Build event in St. Louis in November, where we had a number of funds there. Really take the opportunity to put yourself out there and meet investors and get a really good understanding of how they operate, what their fund structure looks like. And I'll kind of walk through some questions that you can keep in mind as you're doing this outreach. But also, most importantly, give an understanding of your buy box and your buyer profile, your search thesis, because that can really differentiate what's important when investors are looking at deal, because they're oftentimes looking at the operator behind the deal. And so I'll talk a little bit more about what that means. But the sort of the call to learn more about the fund, to check for alignment piece number two here is critical. Oftentimes when a searcher will reach out to us, if we haven't had a call with them previously, the first call is really to get a good understanding of the searcher. Do we like the operator? Do they have the right background? We'll talk a lot in future slides here today about what that sort of operating background looks like. But it can suck up a lot of time early on in the conversation prior to you having the opportunity to pitch the deal. So I think building relationships and being able to network effectively ahead of time is crucial. Some of the questions that you should be asking early on when you meet an investor or when you're talking to a fund, this is even prior to having a deal, or if you haven't been able to do that, you should really always kick off calls by doing your own sort of discovery, for lack of a better term. Investors get pitched all the time. And so what you want to do, and we'll talk a little bit about this on how to run an engaging session, but you really want to be able to pull them into the conversation. And it's helpful for you too, because you get an understanding of alignment. Are they aligned with what my long-term goals and objectives and sort of exit strategy is in the space? So some things you want to consider, what's the size of your funds? Is this your first fund? Have you raised prior funds? Really get an understanding of the investors, their experience in the space. Your fund life cycle, where are you in your fund life cycle? Typical funds are around a 10-year fund life cycle. Ours at Shareholder Ventures is a little different. We're more so of an evergreen style because we're very long-term oriented, but important to get an understanding of where they are in their fund life cycle. If they're closing on year 8 or 9 or 10, maybe they're not deploying as often and they're just trying to set up conversations for the next fund. So getting an understanding of where they are in their fund cycle. Average check size is important that they write into deals. Also, will they invest in potential bolt-ons, or if you have a growth or acquisition strategy, it's important to try to flesh that out early if that is part of your thesis. Understanding their terms, obviously very, very important. Primarily you want to focus on a few things. You want to focus on what their preferred rate or their interest in the invested capital looks like, and the step up. Those are sort of two of the big terms. Typical terms that we see sort of anywhere from 8 to 15% on the pref, and then the step up can typically be anywhere between 1.5 to 2.5x. Specific categories are really important. You want to dig in on that when you're talking to investors. Are there specific categories that you try to stay away from as a fund, or perhaps that you orient towards? For example, at Shareholder Ventures, we stay away from categories that sort of focus on retail and restaurants and CPG and things that are tied too closely to residential construction. We'll talk a little bit more about sort of industry fit when we kind of walk through what our parameters are and how we evaluate deals, but important to get an understanding of category. And then governing controls is really important too. Do you take board seats? Do you have do you set CEO compensation? What are the major decision rights that investors have? Something very important to get an understanding of. Again, Shareholder Ventures, we're pretty passive. We don't take board seats. We don't have drag along rights. We can never force you to sell the company. But important to really flesh that out early on in your conversations with investors. And then really just getting a good understanding of what the investment process looks like. How often does your investment committee meet? Is it weekly? How are you making decisions? What are you looking for in searchers? We're going to talk a lot about that today, which hopefully will be pretty helpful for you. And then also just trying to seek out various red flags, which again, we'll talk about identifying that. So just kind of getting through this, the preliminary pitch session typically is going to be with either a principal or an analyst or an associate, anywhere from 30, 45 an hour or so call, just to see if there's a high level of interest. And then that goes back to the internal funds investment committee. At Shareholder Ventures, we typically meet once a week and we talk about our deal flow. We talk about the types of deals we're looking at, the various operators that we're engaging with. From there, it's usually a follow-up based on a potential deal clarification. So, are there 4 or 5 things that we want extra clarity on? We'll go back to the searcher with follow-up questions. And then from there, if we're really interested, we sort of move the searcher through into a partner presentation. That's typically with our entire investment team, which can be anywhere from 45 minutes to an hour. And then we try to operate and move quickly. So we can make offers relatively quickly, contingent, of course, on QV and financing diligence. But that's just a kind of a glimpse inside the deal pitching process. But again, every fund does operate a little different. We can go to the next slide, Chelsea. So what makes investors say yes? Or maybe this is a question that everybody joined the session for, understand. Very, very briefly, I'll just touch on, I think, sort of at a high level, to get to a yes, we typically, as investors, are asking ourselves these 3 questions, right? Do we like the searcher, the operator? Do we like the deal? And do we like the searcher for this particular deal? It's really every deal has to check off all 3 of those boxes. Otherwise, it's not something that's going to move forward in our investment process. So, as Chelsea was talking a little bit about and you'll probably hear us throughout the conversation today touch on our EIR Entrepreneur in Residence program, which is really sort of the future of our fund and how we're deploying capital at Shareholder Ventures. But our EIR program is very much focused, as Chelsea mentioned, on the operator rather than the deal. So we want to be involved a lot earlier in an operator's search process. And so we're focusing on a few things really. So it's the quality of the searcher. Do they have a strong operating background, P&L, team management experience? Do they have a strong liquidity situation? So PFS, personal financial statement. We look at that for a few different things. Banks like that, but also we want to make sure that you're able to invest around 3% or so into the deal. And then also important as well to have some post-close liquidity. So in case you do need to tap into your own personal savings, you have a balance sheet if you're 6 or 8 months into your owner-operator journey and you experience that J curve and you need to tap into some personal reserves, you do have the liquidity to do that. And lastly, are you motivated to close on a deal? We talk to a lot of searchers that are kind of halfway in, halfway out. Like, I really want to be my own boss and I want to gain this level of financial freedom, but I also like making 400K a year. And I like having good health benefits and, I have a family and I need to provide for them. So for us, it's, we don't require you to leave your full-time job while you're searching, but there needs to be a level of intent and focus and motivation because, we're giving you, as an EIR, we give you about 18 months to close on a deal. And we'll talk a little more how we add value, but there is a timeline. So we want you to be motivated because remember, at Shareholder Ventures, we're reserving cash out of our fund for you. So worst case scenario for us is to invest in the EIR and they go 18 months and then don't close on a deal. There's an opportunity cost of where we could have allocated that capital to someone else. And so those are sort of some of the things that we're looking for that can sort of drive us into wanting to say yes. So we can hit the next slide, Chelsea. Okay, evaluating the target. So my thought process here was to maybe go a little deeper on some of these things, which I think could be helpful. And for all the searchers that are on the call today, I'm sure these are a lot of terms that you're probably very familiar with, particularly if you're in your search currently. But I wanted to provide maybe a little bit more of a lens into how we as investors sort of quantify and qualify some of these categories. And so I hope that this is helpful, and obviously happy to chat with any self-funded searcher that wants to dive deeper in. But I think for us at Shareholder Ventures, we will effectively score. We'll have a scoring system for every deal, and a lot of it's based on these parameters where we're creating sort of a benchmark or a threshold where, if a deal scores above a certain percentage rate, it's something that we know we want to dig in more deeply on because we know it's checking off all of the right boxes for us. And so maybe starting here with going from sort of left to right from my screen here, revenue quality. Revenue quality is a big one. So how do we determine that, or what is revenue quality? For us, you kind of have a few different types of revenue, right? You have recurring revenue, which is typically revenue that's going to repeat on a more of a consistent basis. So think monthly, think annual. A good example is subscription-based revenue or SaaS fees or membership-based revenue. So that's recurring revenue. That's revenue that I think every investor really likes, whether you're in, VC space or ETA. Reoccurring revenue, just to understand the difference, is revenue that's happening more than once, but it's not as predictable or not as you're not able to forecast it as much. So it's more occasional, think intermittent consulting work or project renewals, et cetera. So for us, when we're looking at a deal, if it's a home run deal for us, it has around, let's say, 65 or so percent of total revenue is going to be either contract backed or reoccurring revenue, right? Where also the average customer contract terms, because again, that's important to understand too, what are the contract terms, are at least 12 months or greater, right? That's a home run for us. Now, a deal that would be just a non-starter would be something where less than 20% of revenue is reoccurring, right? So it's not as predictable. And the average contract term is less than 6 months. That's something that we would tend to really want to stay away from. Revenue quality is sort of tied to the next topic as well, which is customer mix. And customer mix, think here, it's customer concentration. And this is, I'm sure, a very buzzy term that you probably often hear in this space as well. Is I'm looking at deals with very low customer concentration, which of course you should be. Couple things to keep in mind for those searchers when you're evaluating or assessing customer concentration and how we look at it as investors. It's a few questions to ask yourself. Are there contracts in place? If so, what are the terms of those contracts? Right? You have multi-year terms. Are they on auto renewal? Are there specific penalties associated with ending those contracts? What's the customer tenure? Obviously the longer equals stronger. So if a majority of your revenue is from a few different customers, but those customers have been with you for 25 or 30 years, that's less risky than someone that has been with you for 1 to 2 years, right? So getting an understanding of what the customer tenure looks like. Seller dependent relationships, right? Or are they embedded into a team and process? So kind of we'll talk a little bit about sort of transition risk today and key man risk, and that's something that's very important as well. And then the revenue model, is it reoccurring or one-off? What do switching costs look like? How painful is it to leave? Are there barriers to entry? So how likely is it that competition is going to threaten this particular contract? And then sort of who is the customer? Are they financially stable? And is the service sort of provided by the seller? Is it likely going to be continued or needed? So again, for us, a home run deal is if there's no single customer that has greater than 10% of annual revenue. Top 5 customers should be less than 30% combined. That's a home run for us. Now, if you're looking at a deal where there's a single customer that is greater than 50% of your annual revenue, or your top 3 customers is greater than 80%, that is scary. You should be scared. We would be scared as investors. So flying through a few more of these, just in the interest of time. So working capital, we can talk a lot about working capital, but for us, we really want to see sort of net working capital be less than or equal to around 5% of annual revenue, and or really digging in on cash conversion cycles. Cash conversion cycles on these deals, on most deals that we like, really should be equal to or less than around 15 days. So ideally, your customers are paying up front, and or you're less than 30 days, and supplier terms can sort of match or exceed that. Home run for us. Love that. Where you get yourself in trouble is if your net working capital is greater than 25% of your annual revenue, or your cash conversion cycles are greater than 60 days, right? You're talking slow collections, you're talking large inventory, weak supplier credit, and that's going to require a real sizable level of working capital to facilitate it at close. CapEx, again, is something that we certainly look at as well. Really there, we're talking maintenance and growth. CapEx should be around less than 5% of your annual revenue. Again, home run for us. If you're looking at maintenance plus growth CapEx that's greater than 15% of the annual revenue, that would be scary for us. That would be a red flag. Um, and then lastly here, talking about sort of financial trends, really what we're talking about there is historical EBITDA and SDE margin stability. So what we look for as at Shareholder Ventures, and I think in general, investors are looking for sort of 3 consecutive fiscal years of SDE that are growing. So think of it as a 3-year CAGR that's above zero with no single year decline that's less than 5% or so. Oftentimes you'll see a deal where there's a significant decline in the following year, the SDE is very high, and then the owner wants to sell. That can be a red flag. Um, what is a real bad deal, or let's call it a red flag for us, or how we would score it, it would be very poor, would be if the latest fiscal year SD has fallen greater than 20%. So if you see a significant dip above 20% versus the prior year or any of the past 3 years, showing negative SDE or signaling a real sort of downward trend, that's stuff that would really scare us. Um, we can go to the next slide, Chelsea. Hopefully this is helpful. Okay, so we kind of talked a little bit about financial diligence. There's other risk factors as well that we can just maybe spend a few minutes talking about. And for us, a few that we look at Shareholder Ventures, and most investors are going to look at are a few of these. So industry fit. So mentioned earlier, so Shareholder Ventures, we really stay away from these high risk industries. So restaurants, low margins, high failure rates. We avoid e-commerce and CPG. We feel like there's just challenging unit economics. We also stay away from retail as well due to declining foot traffic, high overheads, and then of course heavy CapEx and heavy manufacturing. We'll look at light manufacturing, but heavy manufacturing where there's equipment intense, if the business is very equipment intensive or less flexible is something that we wouldn't really be interested in. And then for us, new construction, highly cyclical, very much tied to interest rates. We tend to avoid those. Now, if there's a blend between new construction and renovation, something in the sort of 60-40 type of range, that's something that we've been interested in. So think of it as sort of, is the business operating in a non-cyclical, we say boring, service niche, right? Where there's fragmented competition, excuse me, low CapEx trends and sort of minimal tech disruption risk, which we'll talk a bit about that as well. What would be really risky for us as investors, if you're operating in a business that's highly cyclical, or there's a very low margins or high failure rates or sort of rapid disruption, that's stuff that we would very much try to avoid. Transition risk is something as well that I think is harder to measure. We always like to see seller financing in deals. We want to keep the seller incentivized to stick around through the transition. So, really understanding your transition plan as well from an investor perspective is very important. So, are the day-to-day operations, are they handled by a core team member of the company? Are there documented SOPs that exist for core processes in place? Of course, is there seller financing? Is a seller motivated to stay on and be engaged throughout the transition? Really important how you structure your deal. What would be a bad deal for us as an investor if the seller is really the single point of contact with key customers or vendors, or there's sort of no second tier management or written procedures? That's where the deal gets very, very risky. So ask yourself these 3 questions when you're thinking about transition risk with sellers. Is the seller truly replaceable? Are the customer relationships institutional or are they personal? And then is knowledge codified or is it tribal? Those are really the things that we're looking for. Regulatory risk as well is another category. So here it's really just about sort of personal or highly specialized licenses. So we just try to get an understanding of what are those types of licenses? Or are they routine state, local registrations that are required? Are they transferable, within a certain period of time? We like to see around 30 days or a shorter period of time. That's a good deal that will have sort of less regulatory risk. A deal that has a lot of regulatory risk will be if it depends on a non-transferable, personal or federal license, or that's going to require a lot of education or particular hours that are invested. Those are things that you really want to dig in as a searcher on the regulatory risk piece. Tech AI, Pretty self-explanatory here, but is the core service hands-on? Is it regulation driven, or is the primary service just really easily replicated by some sort of off-the-shelf AI or automation? So that's, definitely want to incorporate that as you're looking at deals, and we look at that as well. And then really the sale reasons. One of the first things that we entertain when we talk to searchers: why is the owner selling? Are they 60 years or older? Are they selling for, are they retiring? Is it particular health reasons? We want to make sure the business the performance is stable, and that the seller has been sort of the only owner or has owned it for, greater than 10 years. What we don't want is if the sale is driven by some distress, or if the owner has only owned the business for, less than 5 years, or if there's significant SDE drop. I had a conversation with a searcher where the seller was in his or her 40s and wanted to go start a tequila company. Not a good sign. We can flip to the next slide, Chelsea. All right, and then lastly here, just going through, and I'll try to get through some of these relatively quickly, but just additional kind of deal terms that matter for us. So typical sort of debt equity split here. Our stack is usually see around kind of an 80% SBA debt with 10% seller note. Shareholder Ventures, we like to put around 7 to 9.5% or so of the purchase price in, and then we like our EIRs to put in around 3%. The bank likes that too, 2 to 3%. So they want you to have some skin in the game. We talked a little bit about seller financing, so can probably kind of skip through there. But in all of our deals, and most investors like to see at least around 10% or so seller financing in deals. I think they view it as a lot less risky, and they know that the seller is going to be motivated to stay on through the transition. And also if it's a situation where it's on full standby, which there's SOP changes recently, so you're not seeing as much of that. But if it is, or if it's an interest-only payment, it can also sort of lessen the DSCR as well. Add backs, just no crazy add backs here. We just look for clean adjustments, that are sort of owner specific. What we don't want is sort of reoccurring or poorly substantiated items that the bank is likely to reject. Mentioned a little bit about our searcher equity. So again, we liked our EIRs to put around 3% or so of cash into the deal and have an additional 2% post-close. And again, the SBA kind of wants that as well. And then for us, really kind of size, where at SHV for us, it's a sweet spot is sort of 1 to 2 million SDE. We can flex as low as 750, but we're really looking at sort of enterprise value in the $3 to $10 million range, and sort of the 3 to 5x multiple. So, once you start getting below 750, there's just not a lot of cash after you're paying your own salary and through debt service to kind of reinvest or even issue distributions. And so it kind of gets a little hairy for us deals that are too small. So I flew through that one. Chelsea, we can go to the next slide. I won't spend as much time here on the next slide. Oh, oh.
This is the next slide, Andrew. I think
sorry.
Hopefully
next slide over to you.
Next slide over to
you. Over to you, Chelsea.
Can you hear me better, Will? Hopefully. I dialed into my phone, so hopefully it's not worse.
Volume better. Yeah, volume is better. You're less clear, but we'll take it. Thank you.
Okay, perfect. So let's talk a little bit about what the investors are looking for in you, right? So it's going to be very similar to what lenders are looking for in you. It's the same risk mitigation, right? They're all underwriting the risk of the deal. And so they're going to look to see if you have enough liquidity, right, to fund the deal, to cover your expenses in the event that things aren't going well, to make sure that you can cover the debt service in the event that things aren't going well. And so most lenders will require you to have post-close liquidity as well, which I know Andrew referenced. They're going to look to see if you have the transferable skills to run the company you're trying to buy. And so I had this question yesterday, in the cohort where they were wondering how the lender views buying a company that you have no knowledge of. And it's really important. So everyone probably knows by now the lab relies pretty heavily on making sure you understand who you are and can position yourself to the market as the right buyer of the business you're trying to buy. And so everyone involved, from the seller to the broker to the lenders to the investors, want to make sure that you can actually do what you're trying to do in the company you're buying. And so it is a huge risk factor if you don't have the knowledge base. And so if you don't have it, you have to be able to explain how you're going to fill that gap, right? And maybe it's that you're going to be keeping somebody on board that's already there. Maybe they're going to become an equity partner, or you're doing profit sharing or something to incentivize them. But you have to have a story as to how it's going to make sense if you don't already have the knowledge. Same thing goes for the operating track record, right? So they want to make sure that you have actually led teams and managed budgets before and operated in a way that transfers to, like, sure, you should, buy a $5 million company. I had a call yesterday with somebody that was trying to figure out what size company she should buy. And it's the same kind of advice that I would give them, right? So at the end of the day, if you have run a company, and this is like the EIR candidate we just interviewed, it's like if you have run in a division of a company, right, for 10 years, you've had P&L responsibility, you've basically run a company in a larger company. So like buying a large company, your leadership experience, your operational experience will transfer. But if you've only led small teams in a bigger environment, you've not necessarily had P&L responsibilities, you've managed a team of maybe 3 or 4 employees, maybe that means you should be buying smaller, right? Like everyone, I feel like, will tell everyone to buy as big as possible. But to me, you need to be buying as big as is appropriate for your operating record. And the next thing they're looking for is kind of how clear are you? And Andrew kind of alluded to this. Sometimes searchers will come in and it's like they're in love with the idea. And so they're talking in very superficial terms, right? Like this is something that they were kind of sold a dream that from all of the, inundation of our news feeds with this kind of information. And so you need to come forward with a very clear plan, right? So that they understand, like, is this something you're trying to do? Are you building a legacy for your family? Is this something you're trying to hold? Are you trying to flip businesses and just make money off of them, and you're only trying to do a 2 or 3 year hold? Like, what's the timeline of when you're trying to buy? Like, you need to show that you're taking this seriously. The next thing they're looking for, which is what we evaluate even for lab members, is like, do we want to keep working? Because we are a lifetime membership. It's like, do I want to work with you for a long time? Most investment funds, not all, there are some shorter term investment funds, but most of them, this is a long-term play, right? It's different than like a startup world. Most of them are backing SBA loans or acquisition loans, and it takes time. So you want to make sure that they want to work with you. So you want to make sure that you're putting kind of your best image forward. They're also going to want to make sure you're not trying to buy businesses with no money down, right? Using only their money, and there's no commitment from you. And so you can also bring forward capital. And they do vary. Like I know Andrew mentioned Shareholder Ventures requires 3%. Different funds will require different amounts. Some investors won't require you to have a fund or any money in. I'll tell you, lenders don't love that. And I would argue that's dangerous to buy a business if you don't actually have any money. And if you're saving it for, a rainy day in the event of, kind of risk mitigation, maybe I can make an argument for that. But most of them are going to want you to be willing to bet on yourself, right? Like if you were going to underwrite a deal, you would want to make sure the person was willing to do what they were asking you to do. The next thing they're looking for is, are you approaching this in a methodical way? Like, is there actually like a process in place, right? It's why a lot of investors like working with like lab members, because they have a process to follow. But part of that too is how you're responding to a process. I was just talking to lab members yesterday about how everything's a data point, right? And everything's a data point. If the seller's unresponsive and you're not getting the information you need from them, if the broker's unresponsive or giving you a lot of ad backs, like everything tells you a little bit about that person, about how they chose to run a company, about how it will be through the integration process and transition. And so you're also telling them in how you choose to work with them, how it will be to work with you. And so how responsive you are to their requests, how much you follow through on the things you say you're going to do, how prepared you are in the meetings, that's just clues for them, right, about how you're going to be at running a company. Another thing we look for on search calls, or like when we do strategy calls with folks, is how open you are to feedback. If I push back on something that you're saying and you get defensive, I certainly wouldn't want to be a part of your future deals, right? Because you want there to be an openness to dialogue, so that you can provide the advising support that someone's asking you for. And then last piece, I will say not all funds look for this, but all the funds that we work with in the lab, especially Shareholder Ventures, which is why I agreed to merge the lab with them, is they're looking to make sure that you're somebody of integrity, right? Like this is a big thing, right? To partner with somebody, to give them backing, because from a fund perspective, it's a commitment that you have, a fiduciary responsibility you have to your investors to make good choices, right? And then from a values perspective, you just want to make sure that this person is going to do good things for the companies they're buying. And so some funds, many of the ones we work with in the lab that we recommend for lab members, they are going to check references. They are going to make sure that you are, you have the support that you need to be successful from your spouse. And, they're just going to make sure that it's like a holistic partnership and it makes sense altogether, because they're partnering with you on a bigger scale than just, it's not a transactional relationship, I guess is what I'm trying to say. So at the end of the day, they really just want to make sure that this is the right business for you, right? They're going to look at all the things that we talked about, but they also are going to talk about whether or not there's a clear plan for the seller. And I know Andrew mentioned, like in the pitch deck conversation, is like, is the business a product of the seller, or is there actually value in the business, right? And so we always say that you should never buy a business where the hole left by the seller isn't something you can fill, or that you don't have a plan to fill. The next thing is your value as a buyer appropriate for the business that you're buying, right? So if you're buying a business and you're saying, hey, I'm going to do this thing, is it appropriate for the business, and have you already done it before? And then the next thing is really just, do you have solid management skills so that the team isn't at jeopardy? And is there a plan in place for keeping key talent? I think the thing that I see most searchers struggle with, and I really liked that when Andrew and I were putting this deck together, he called out, there were a couple of things. The first thing he told me was like that searchers get kind of tied up with is that you shouldn't expect to close during your pitch. Like that's not actually when you're getting investing. And I felt like that was kind of a light bulb shift in my brain, that I think that members or searchers should kind of get that mindset. But then the other part is that you need to actually have a clear growth plan that's an actual plan. And I think this is where searchers get tied up. So I talk to a gazillion searchers a day, it feels like, and often I'll hear, well, they've never done sales, so I'm going to go in and we're going to do sales. Everything's referral based. And so I'm going to introduce sales. That is a strategy, but it's not really a plan. There's nothing telling that's actually going to work for you. And it's one of these things that I think everybody thinks, I'm just going to buy a business that's never done marketing and turn on marketing, it's going to work. And it's very actually hard to find out how to attract, convert, and deliver. Now, if you're buying a company that's never done sales, it's all referral based, and you're like, hey, this business could work really well in this industry that I've been a part of, and I have direct lines to the key decision makers in the supply chain of this healthcare system, and I know I can kind of grow into this new product line in this with this business. That is a clear plan, right? And so they want to make sure that you're not just kind of spitting things out at them that it's kind of the growth opportunities you read in Sims, right? Where it's like, oh, they can just hire a sales team. Like they want to make sure that these are actually built on things that can work, right? Repeatable successes that you've already had, not just concepts that like if you check, like if we redo the website, suddenly everything's going to turn around. It doesn't work that way. You have to have concrete plans for how you're going to grow the company. And I thought it was interesting that from an investor perspective, they really want to see, a 5% or more increase over the first 5 years without seeing a massive increase in incremental CapEx. So if you could grow, but it would be extremely expensive to grow, they're not as interested. And I thought that was interesting. I'm going to hand it over to Andrew to kind of walk through the math behind the deal.
Awesome. Great. Thank you, Chelsea. Yeah, and I know in the interest of time, I'm going to probably fly through the next couple slides, but in particular, this slide. So really for investors, we're measuring our success and our return on IRR. It's really IRR. That's the key, which is the internal rate of return. So it's what's measuring sort of what annual return did the investor, effectively earn on their cash. And so think of it as sort of accounting for when money is returned. So returning cash early via distribution significantly boosts IRR. So which is why at SHV and other investors in the space try to align terms towards distributions. So we at SHV, we also enable our EIRs, when they're investing their cash in the deal, so let's just say their 3% that they're putting in will be classified as preferred investment. So they'll effectively be investing on the same terms as us. So they'll share in distributions right away as preferred investors. It's something that we try to do to help amplify their CEO compensation. So with this we typically will target anywhere from 30 to 40% in IRR as investors. And oftentimes, because as Chelsea mentioned, when modeling out something as low as 5% year over year growth, I mean, it still can get us to that sort of 30 to 40% based on our whole period. And we're typically looking at sort of a 10 to 15 year hold at the very least. We want to be long-term oriented, but you're talking cash distributions that are starting in year one. You're talking a rapid sort of debt amortization, right, which is going to increase your distributions later once your senior debt's repaid. And the equity that you're invested, it's small, really relative to the enterprise value. I think 10% equity in a $5 million enterprise business. In your searcher, as if you're a searcher, you're owning 100% of the common, and so which is why typically there's no step up for searchers versus investors. Think of it this way: it's sort of what you owe today is what you'll be worth tomorrow, which is again is another reason why we really love this space. We can jump to the next slide, Chelsea. I just try to wrap this up real quick. And then I know we got some Q&A, Will, so I'm gonna leave some time there. Just high level, this is sort of recommended pitch deck framework. It doesn't, there's no sort of, it's like resumes. You should talk to 100 different investors. You probably get 100 different perspectives on what your pitch deck framework should look like. This is just the standard one that we like and that we've seen. As Chelsea mentioned this too, investors don't require you to have a pitch deck. I personally like it because it shows how you're thinking about the business. Oftentimes we'll talk to searchers and they'll just have a sim and they'll walk you through sim and some financials, P&L, balance sheet, or tax returns. But it's nice to have that added layer of presentation. Particularly, what I like to see, two things just want to flag or call out is your investment thesis and your buyer profile. This is something that I think Chelsea and her team at the lab do an incredible job of. So for, as a searcher, it can really differentiate you from the next person that you're competing with that's trying to buy that same business. What is your investment thesis? How are you conducting your search process? How credible are you as a searcher? With our EIR program, we're pre-committing $500,000 into your deal before we even see your deal. So when you're talking to sellers and brokers, they know that you're a very credible buyer. You have an EIR profile on our website. You have cash from one of the largest funds in the space, and so hopefully enables them to get through that first layer of defense. But the lab does an excellent job of really qualifying and quantifying what your buy box and buyer profile look like. And then the other thing I would just call out is what I love to see in decks when we're being presented to us is sort of the deal risk. Like I love when a searcher says, all right, we're going to talk a little bit about the deal. Here are the 3 or 4 things that I feel like as a searcher are the biggest risk factors here. So I want to flag that out right away. But in the deck, you should also have simultaneously, here's how I'm going to mitigate each of these potential deal risks, which I really like how that's laid out when searchers present that. So, okay, next slide, Chelsea, if you don't mind, and then pitch session recommendations. Okay, so I think just the one here that I would just like to flag is you want to make it engaging. Even when I was running Techstars Accelerator with partner Jordan, who's our CEO at Shareholder Ventures, we listen to so many pitches, and oftentimes you feel like you're being talked at as an investor. And I've seen investors on pitches will literally multitask and do other things. So you want to try to pull the investor in, which I think is why it's good to check for that alignment early on. You also some investors will see what I like to see is, hey, Mr. and Mrs. Investor, look, I know we're gonna spend a lot of time talking about the deal I'm looking at. I sent you the sim ahead of time. Perhaps you send the deck ahead of time as well. Let me know where the best place to start is. I'm happy to kind of walk you through, slide by slide in my approach, a little bit on my background. What we don't want is for an investor to say, Hey, Chelsea, tell me a little bit more about your operating background. And then 25 minutes later, you're still talking. That is going to be an immediate tune out for an investor. So I think that the best pitches are most engaging. They pull the investor in, and by doing that, by stopping periodically and saying, "Hey, does this make sense? Or any issues with this? Any pushback here? Do you understand how I'm thinking about this?" You can by doing that, it allows you to really get an understanding of what's most important to the investor. They can be, "Hey, look, good. I'm good on all this. Like, I really want to dig into the financials." Or like, "I really want to talk about your growth strategy." Like, "Yeah, I understand what the business does. We don't need to talk about that. Like, let's just talk about how you're going to grow this thing." And so, by making the pitch more engaging, I think it enables you to extract some of those things out. So, over to you, Chelsea.
Yeah, so this is just an example of what's in the bundle. The pitch deck playbook is honestly just notes I was taking as Andrew was talking about all of this stuff to give you guys just a reference guide since it can't all go on the slides. And so highly recommend that you download that. I think that's it.
Round of applause. That was great, guys. What a dense and valuable presentation. It's striking to me how, so as an investor in or as a GP at Minds Capital, we invest in independent sponsor deals, which are in some ways different, but our diligence factors are very similar. And maybe that's just the case for kind of lower middle market deals from, $500,000 of SDE up to 5 million of EBITDA. But the all of those risk factors that you took us through are ones that are just very, for the audience, you should really, internalize them, because this is not just about search. Even in lower private equity, like low end private equity, it's the same. So it's just striking the similarities between your process, our process, the process that I see independent sponsors take in their risk assessment. So anyway, great stuff, guys. Some quick notes before we turn to questions. We have 5 minutes. Bunch of good questions, but so just before that, Ron West says, "What an excellent presentation." Where'd that comment go? He's got to jump, but it's definitely a rewatch. So just some compliments from the audience. Got the question 100 times, as we always do. Yes, you'll receive the recording and the slides. It'll go out by email, always does, in the next day or two. And then finally, links, everyone. So on December 11th, Tim Erickson is coming back to model an actual investor style SBA deal. So we'll actually go through a spreadsheet and really show you how the numbers work at a granular level. So register for that. It's right there in the chat. And then the investor bundle is at that link that Chelsea just had on the screen, but there it is as well. So you can download the investor bundle there. Great. Let's squeeze in some quick questions. Let's see here. I have the ones written down that I really wanted to get to, but there are so many of them. Sorry, one sec, everyone.
And we will start hosting AMAs, just so you know, Will, on Friday mornings, I think.
Oh, good.
Because we always get a lot of questions that we don't get to. And so that should start coming, where we'll just jump on the phone and be available for questions for 30, 45 minutes on Friday mornings.
Oh, great. That's good. That's a great idea. Awesome. Okay. How do you view low EBITDA margin that has significant operational upside? So looking at a business that has great operations, I guess not great operations, but hasn't been optimized. So in other words, the business has good bones. There's a lot of low-hanging fruit, and levers to pull, but as it is now, it's not as profitable as it could be, and so might not look so great on paper.
Yeah, I'll take a stab at that one, but yeah, Chelsea, feel free to jump in too. Yeah, it's a good question. Well, I think For us, that's why it's so important to get an understanding of the operator and what their skills and how that translate into this sort of owner operator type of role. Like I think for businesses that have lower EBIT or SDE, as long as there's a general level of consistency, there's no significant dips, which again scare us, quite frankly. But if there's an opportunity to grow the business through things like, well, an example is, we invested in a printed circuit board company, PCB space, and I thought the owner operator, the searcher, had just a great opportunity for that business to just institute things as simple as like implementing a CRM system. So it's sort of systemization and digitization of a workflow. These operational efficiency improvements. It could be something like a market expansion, or it could be something like focusing more on sort of stronger customer retention strategies. And so I think the short answer, Will, is yeah, we're definitely open to that. And which is why I think with the EIR program, we're betting more so on the operator versus the deal itself. So we definitely be open to looking at those types of deals.
Yeah. Could I also take a stab at that one, Andrew?
Yeah, please. Yeah.
So obviously better if all the opportunities to improve the business are there and it's already got good margins, because you can find those as well. Now, a lot of this exercise is talking about ideals. The perfect business doesn't exist, but it's those levers to pull, that low-hanging fruit. You want it to be if something has to work for the business to be viable or to be interesting, that's a little scary. You want it to make money now in spite of itself, and then have all those levers be bonus. So anyway, that's kind of how I think about it. A couple people asked a variation of, do investors typically conduct their own Q of E separate from the searcher?
Yeah, good question. Typically, at least from Shareholder Ventures perspective, is no. We sort of have our preferred kind of list of QEV providers that we will introduce our EIRs to. So I think it's important for us that our EIRs are sort of using our preferred deal teams. So our M&A lawyers, QEV, financial diligence providers, loan brokers, for example. Those are sort of the three buckets that we feel like are very important and can really kill a deal. So look, it de-risks it for us, and it de-risks it for the searcher, knowing that they have the best in the business that are focused on those three areas. So typically we'll have we'll give our EIRs a couple options to choose from, folks that we think are really, really good, and then have them sort of run the financial diligence in the QV. But I highly suggest for anyone buying business, don't not do a QV. Well, I don't know if you have strong opinions there, but we've seen a lot of deals die and the searchers go bankrupt because of that. And so highly, highly encourage all of you to use a QV as you're going through your financial diligence.
Yeah, absolutely. No, agree. Yeah, just, that $10,000, $20,000, $25,000 price tag can scare you off. But better that than have your life ruined. So, how do you, investors, determine the correct post-close liquidity number for the searcher and the deal? Great question.
Great question. Yeah. So we look at a few things. We at Shareholder Ventures, we basically say, look, we want you to have at least or around 250K in liquidity for us to really want to engage and pull you into the program and support. And so how that works is we like to see, and again, it's all deal dependent, depends on the size of the deal, but we like to see around 3% or so invested in the deal, and then another 2% in post-close liquidity. So let's call it 5% of the total project cost in liquidity. And again, reason being is, once you different from venture fund, when you're in the venture game, you can always go out and raise another round of financing. And every 18 months you raise a round, you take dilution, and again, not a misalignment there. But here it's what you have at close is what you have at close. And so we always encourage all of our searchers or ERs to take a line of credit, try to beef up the balance sheet as best you can. However, there may be an opportunity for you that you need to tap into your own personal balance sheet to be able to shore up the business if it hits some type of bump once you're 6, 8, 9 months into the journey. So that's why we like to see around 250K in liquidity for our searchers, for our EIR program specifically.
Mm-hmm.
I would just say from a post-close liquidity perspective, it's very dependent on the type of business you're buying. And so you need to make sure that it's appropriate, right? So like a business with low overhead doesn't need as much post-close liquidity, right? Because if something goes wrong, it's not like you have to funnel $1 million to keep the business running. But something that has a higher cost of operating, you probably need to have more liquidity for, right? Especially if it's got like, let's say you're buying products, and it's got a long inventory cycle, right? Or you're like leading into, it's cyclical, right? And so you do a lot at once. You need a lot of cash for that. And so those are, and I know everybody wants percentages, but it really is just logic, right? When you're looking at the deal, it's like, how expensive is this to run? And you just want to make sure that you have a decent stash to cover that, right? In the event that things go sideways. And so I've seen anything from a lending perspective where they'll want anything from 3 to like, I've seen as high as 16% of a purchase price and liquidity. And it 100% depends on how expensive that business is to run.
Yeah. Yeah, good point. But despite what you just said, Chelsea, that it does 100% depend, people will walk away with a number that Andrew said. Andrew said, you said 5% of project cost in total. So not 5% after the acquisition.
Correct.
5%.
Yep. Correct.
Yeah.
Exactly.
So on a $5 million deal, everybody, enterprise, maxing out the SBA loan, that's $250,000, $250,000. In case you needed me to do the math. Wait, did I even get that right? Yeah, I did.
That's better at math than me, Will. That's
all right. Well, everybody, we're at 1:04. Can we do 2 or 3 more questions, Andrew and Chelsea? Do we have a couple more minutes?
Yeah.
Okay, we'll do a couple quick ones here. Oh God, already got one like that. Come on. Let's see here. There was some good ones in here that I just don't want to. Okay. So Andrew, well, both of you, the whole presentation was about the risks and what is too much risk. And how do you all, basically, this is a question about mitigation through structuring. So, Andrew, you gave a lot of examples where you were like, you actually gave hard numbers on like amount of, thresholds of recurring revenue, for example, particular numbers. How hard are these cutoffs and how do you receive people who are structuring around them? Forgivable seller note, for example.
Yeah, not hard cutoffs, Will. I think just sort of general frameworks to operate off of. I think like for an example that I'll use for us is like we probably wouldn't do a deal that has no seller financing, and not just because we feel like it's a good structure to have some level of seller financing. Let's just say there's a significant dip in revenue. We would probably want to see like a 15, again, depending on the size of the deal, every deal is different, but like a 15 or 20% forgivable note if there's a significant dip in revenue or to compensate for that. It also enables the seller to be involved in the business post-close, right? Because they are incentivized. There's some upside for them with seller financing. So that's something that would be sort of a hard rule for us, but depending on the deal, it could fluctuate. It could be a 5% seller note. It doesn't necessarily have to be 10%. But would we do a deal with like no seller financing at all? Probably not. For those reasons stated. So
Yeah.
Chelsea, I don't know if you have any sort of strong feelings on any of that.
No, I would assume, like, again, you're the investor person, so you know how investors view it. But I would assume as long as the risk is appropriately mitigated, kind of like we talked about with like presenting yourself, as long as you can explain that you have a plan and the plan is an actual plan to mitigate the risk, then it's probably okay as long as it's truly mitigated. But yeah, I again, if you think about this from an underwriting perspective, it's like everybody's just trying to make sure that they're making the best choice in the least risky way possible. And so, yeah.
Yeah, the transition risk is I think it's one of the hardest ones to measure, because you can sort of quantify revenue and margins, et cetera, but hard sometimes with transition risk and really getting a true understanding of what's the team in place. Like we were talking to, or I was looking at a deal where the seller was very, very hands-on, but there was also a sort of number two, let's call it a GM, and had been with the business for about 30 years. And the new owner operator was planning on carving out some common to incentivize that GM to want to stay on because the GM was just crucial and essential to the business. Hard things that you can't necessarily quantify and measure sort of financially, but like that is a huge transition risk that we would want to make sure. What is your plan on keeping this person in place? And if not, do you have a plan to replace this person, on day one? Because if they're truly vital to the business being successful. So things like that, we'll look at a lot of that type of stuff.
Yeah. So many people that we see in podcasts and on webinars did not have actual P&L experience before acquiring their company. So when a searcher doesn't have P&L experience, what else are you looking for in lieu of that? So we've talked about a little bit, but let's just say the person just doesn't have the experience that ideally they do. There's so many examples of still people being successful on this path. How do you respond?
Yeah, for sure. I'll take a stab, and then Chelsea, feel free to jump in too, because you work with so many searchers. But I think one of the things that we have, I think, in place with Shareholder Ventures, Will, and it's sort of to that specific point is, we have an entire back office apparatus that's focused on fractional CFO services. It's called SMB Edge. We built it internally. There's sort of different phases of the search. You have, the search process, you have kind of getting through closing, and then post-close operating can be really difficult and it can be very lonely and solitary. And so having sort of enterprise level support, particularly if it's an owner operator that doesn't have over 3 years or so with full P&L authority or have a significant sort of P&L background, we try to mitigate that risk through our own internal SMB Edge fractional CFO services that does accounting, bookkeeping, financial planning. We also do sort of IT, HR, staffing, so sort of a full suite of services. But and particularly, we make it mandatory that you have to use our SMB Edge on the accounting side because we just feel like it's so important to have a really good understanding of your cash flow. Our CFO services can also identify various trends in the business, which can be helpful versus like a stale or static bookkeeping service. We want to be looking at sort of more forward facing and forward focused. But to mitigate that, I think the operating background, obviously someone has a really strong operating background, a really good sort of team management experience. They've managed a team or a staff of, let's say, over 20 people or so, and has a really clear sort of buy box thesis or has a goal exit strategy that aligns with us, is very motivated, has sort of a leadership mindset, cultural alignment. We trust the way they're sort of being analytical and their investment judgment. Those are the things that we're looking for from our EIRs, and it can sort of compensate in some cases for a lack of a P&L authority.
Yeah. I would just add to that, like if you searcher just really don't have this stuff, then you can still do it. And there, as you point out, there are countless examples of people doing it. But it's basically on you to figure out, how to convince the investor. It's not on them to spoon feed you how to convince them, right? So if you don't have the qualifications that they're looking for, demonstrate your ability to be a successful leader by coming up with a story. That's step one in demonstrate. If there's a meta point here for the investor. If they're finding themselves persuaded by you, even though you don't have the perfect on paper qualifications, they'll also say to themselves, this person, is persuasive, and that's going to be a great leadership skill to have in the seat. So anyway.
I think that one thing.
Yeah, Chelsea, sorry.
No, it's okay. With P&L experience is important, but I also think that, yes, people do it really well on podcasts, people do it really well with or without the background, but they also do it really bad. And I think the key isn't actually the P&L experience, it's buying a business that matches your skills. And I think that there's a little bit of a focus on the P&L experience, but like start smaller and go get the experience, right? Or go in your career, go get something that gives you that experience. But I think that it's not a finite, like when we have our EIR rubric, it's not like it's a deal breaker, right? It's just part of the puzzle. It might be a yellow flag that you don't have P&L responsibility, but if you've done a bunch of other stuff that meets the criteria, then it gets weighted. So I want to make it clear that like everything we talked about isn't cut and dry. It's like, oh, you don't do this, we're done, right?
Exactly.
Everything is kind of weighted and it's cumulative into your likelihood of success, I guess.
Yep. Great point. Key point. Okay. Well, no, that's kind of a similar question. Okay, last question is just the seller motivations. This is always an interesting one because you would love to see that the seller just wants to retire. How flexible are you on that point that if the seller wants to go start a tequila company? That does happen. People want to take chips off the table, go do something else, especially if they've been grinding for a while. Sorry to unsolicited provide my advice. I've softened quite a bit on that one. So, but please.
Yeah. No, and to your point and to Chelsea's point too, a lot of this is not hard sort of rules set in stone. I think in an ideal world, yes, the seller is 65 years old, has been with the business for the last 30 years and is retiring. It doesn't have to be that. And we're of course open to various offshoots of that situation. So I think for us, we just want to make sure that it's not a business that's declining. There's no hidden red flags that we're not seeing in the business. Like if this business is truly just spitting out cash flow, then why would you walk away from this business? Now, in some cases, it's just that, hey, look, I've had enough, and I want to try something else, and I want a new owner operator to sort of continue my legacy. I think what we just don't want is sort of this kind of sale driven by distress, if you will.
Yeah.
Or a significant dip or drop in ST or EBITDA, or there's some sort of litigation or regulatory action, or they just lost their biggest customer, and now it's like, all right, well, business is probably going to significantly deteriorate, so why don't I try to sell and get a better multiple? That's sort of what we're trying to index against. But to your point, well, not a hard rule. It's just something that we in a perfect world, yes, but we would just want to dig in a little further on and then how involved will they be through the transition? If there's no seller financing, they just want to get the heck out of there on day one. That raises a red flag for us too.
I'm curious from both of your perspectives as investors, because we're seeing it more and more often, and I kind of thought we would a couple of years ago. I mentioned it. How do you feel when the listing was acquired in the last 4 to 5 years and it's back on the market? How do you view that?
I don't want to speak
please.
Will, but I would view that as a potential risk. I would want to really dig in on why and really dig in on the financials and not only in the past 5 years while they were owning the business, but prior to as well. I would view that as a risk. I mean, we like to see a business owner that has owned the business for at least around 10 years or so, sort of less than that. For us, it becomes a little risky, but I'm curious to see what your thoughts are.
Yeah. Well, I'd say, to just repeat, Chelsea, what you've already been saying, nothing, every case is so unique. So it would certainly jump out and be something to really scrutinize. Maybe there's a perfectly good story there. Perfectly good stories could be, for example, let's just realize that most independent sponsors and in fact, investor-funded searchers are pro-forming an exit after 5 years. So it shouldn't be incriminating that somebody's exiting after 5 years, because that's what we're all going to be telling investors as we try to raise money, right? But still, it does feel like, that's a little too short. And it would be also, of course, let's not ignore that it's a spectrum. So if somebody bought the business a year ago or 2 years ago, that's a much bloodier red flag than if they bought it 5 years. And as the time
Yeah,
increases, it
mine
makes
was
me feel
sub
safer.
5 years was the
Sub.
question, like
Sub.
earlier than 5 years.
Yeah.
Because you're seeing
Yeah.
that a lot now. Like we'll have members bring a deal and they're like, "Oh, this was acquired 2 years ago." I'm like, "What?"
Yeah. That would be 2 years.
Well,
So, yeah, you get really low and it becomes very red flaggy.
Yep.
Yeah.
Yep.
Yeah, I'm with you though. 5 or more. Like we've had members exit right around like 4 or 5 years. But again, it was fine. The performance was doing this. That's why they were able to exit. But that's not necessarily the deals that are coming back on the market. I was just curious how you guys would feel about it because we've seen a handful and I'm like, I don't know.
Yeah. Well, and in all of these things, in a seller like that who's selling after a seemingly short amount of time, or going back to the question, Andrew, about a non-retiring, somebody who's selling and they still got 10 and 20 years left in their career, why are they selling? All of those are areas to dig and just push harder on, and the more of those there are, the more intense and careful your diligence needs to be. So if you have a seller who's 40 years old and saying, I want to go do a tequila company, could be fine, but you need to look that much more carefully at, you need to diligence it that much more careful. So a lot of these are more like signals that you need to diligence more carefully than they are binary yes, no flags.
Right.
So yeah, they're just data points.
Yeah. Go ahead, Chelsea.
No, they're just data points. That's what we always say, right? Everything's a data point.
Yeah.
We just dig in a little.
Yeah. I want to say I have nothing against tequila companies. I think they're great, but yeah.
All right, guys. Well, let's wrap it up. We've kept everybody longer. We're starting to lose people. They have the rest of their days to get to. But what a great presentation! What a great idea, guys! I love this idea, and of course, and then the execution was wonderful. So the 200 of you that are left, check out those links. Register for Tim's modeling tutorial webinar coming December 11th. Get the investor bundle. Both those links are in the chat. You'll get an email of the recording and slides of this in the next day or two. And thank you everybody for your attention as always, for coming. And Chelsea, Andrew, excellent presentation. Thank you too. And
Thank you.
this ends the webinar. Bye.
Hey guys. Bye everyone.